The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The NASDAQ dipped into correction on Wednesday. Microsoft pulls it out of the hole this Thursday. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Emily Griffey. We're kicking you off to the closing bell here in the U.S. Let's get a check on how markets are trading on this Thursday. The S&P 500 up 1.6%. The gains here really in the NASDAQ 100, though. That tech-heavy index up 3%. A lot of that, though, coming from the strength in Microsoft on the back of those strong earnings. That individual stock up about 17% right now. Also want to highlight the SOX index here. Those chip stocks still down about 20% on the month, but getting some much needed relief right now, up about 7.5% after strong earnings from Samsung, ARM, and Lam Research. Finally, the yield curve still steepening. Even after a benign PCE print, we are still seeing that 30-year yield up above 5.2%, Romaine.
Meanwhile, we go back to equities. I'm going to throw a little bit of cold water on this rally because it is indeed narrow. The outsized effect of Microsoft, that is the dominant factor here. That company set for its largest one-day increase in market value for any stock in history. As for everyone else, forget it. Barely 35% of the S&P members in the green. I looked at the data, and every session this year, this saw 35% or fewer of the names in the green. The S&P as a whole closed in the red. Today's different. Microsoft getting a pass from investors after that earnings report. The issues about Capex spending now put to ease, at least there, because Satya Nadella was able to articulate that his AI investments were starting to pay off. That's the ROI everyone kept talking about. The opposite case, you take a look at Meta, heading for what is now an 11-day, 20% slide. No forgiveness there. That's the theme of this tech earnings season, which continues tonight with Amazon trying to bounce back from a 4-week 17% slide, and Apple, whose more measured pace of spending that actually helped it make it the best performing mega cap stock over the last 5 weeks. It's all about the balance. Capex spending is fine as long as the cash flow and profitability, well, provide some sort of commensurate return. And for most companies, it's not there, not yet. And that's why we're looking at once dormant, but now widening spreads in credit markets tied to the AI borrowing binge. Throw in the Fed, interest rate uncertainty, and a report out just a few hours ago suggesting GDP just a bit softer than thought. That is the setup. Here's Ken Shinoda.
If you look at the corporate bond market, spreads for riskier stuff are going wider. So the market is starting to sniff out some issues, especially in tech, AI, hyperscaler type parts of the market. There's a company we follow, CoreWeave, that's a public company that's involved in the data center market. You know, their bonds are down 15 points from the middle of June, trading in the teens now. So there's some problems brewing in the credit markets. So cost of capital is going up.
Well, who better to talk about credit markets and the cost of capital than Bruce Richards, managing partner and head of CVC Marathon, $80 million in assets under management, and of course, decades of experience on Wall Street under his belt. Bruce, great to see you.
Romaine as well.
No doubt about it, cost of capital is going up, not to an extreme level. When you look around sort of what's going on in the credit space, whether it's in public markets or private markets, are you worried at all?
Not worried at all. The AI news story, the data center build-out story, that bull case, which is very real, requires a lot of funding. And so therein lies the opportunity. But there are going to be winners and losers, and being able to differentiate between the winners and losers is very critical. And so this year, the total Capex spend between the hyperscalers, the AI and data center build-out, we believe is something around $750 billion, and next year around $1.25 trillion, according to Goldman Sachs and Morgan Stanley. And so working with those numbers, the opportunity is then to fund the winners. And so having the power in place, having the shell, having the chips, the GPUs, and the cooling systems, and the transformers, and having it all lit and ready to go with an IG offtake is a wonderful opportunity at these much wider spreads. And so if we can buy credit at the much wider spreads to fund the winners, that's a very positive development.
Well, it's interesting you say that, because yesterday we were talking about these wider spreads more from sort of the negative aspect of it and sort of what signal is being sent. Some people say, look, this is just kind of basic hedging rather than some sort of extreme bet on a down drop. You see this as opportunity.
Well, look at it this way. The IG market in totality is an $8 trillion marketplace here in the U.S., $3 trillion on the non-IG side. This is the public markets between high-yield bonds and broadly syndicated loans. So together, $11 trillion. Only 4% remain. Only 4% of this entire marketplace is the hyperscalers, the data center, and AI funding. But 20% of all new money raised over the last 12 months is coming into the space. So it's simply supply versus demand. So I ask you, if the fundamentals for the companies are actually just as strong because they're more profitable than ever, and you're getting paid a lot more to take that risk just for supply, I'll take that extra earnings for our investors because we'll perform even stronger than we have been performing to date. We've been performing very strong, and that gives us a little extra juice. But again, there will be losers. So you take a look at a data center deal that funded the shell and the entitlements and couldn't get the power. Billions of dollars being sunk into a deal that is losing money. And there are deals like that that are done. So you want to make sure it's all green lit, ready to go, with the power in place, with the offtake and the lease in place, and that's when you want to fund. You want to fund the winners.
I do want to stay on this idea of supply and demand because there's just so much need for capital right now. And we actually saw this week, Ken Shinoda mentioned CoreWeave, a lot of borrowers needing to pay up, needing to boost projections to get these deals done. We saw it with Proofpoint, Ancestry.com, just to name a few. Do you feel like right now investors are actually getting the upper hand in credit markets?
Well, they're being funded with free cash flow from the companies. They're being funded in the equity market with equity raises. And they're also being funded in the credit markets. And we're getting paid a much bigger return than we otherwise would if it wasn't simply for supply. And so, again, good offtake, great credits that are underlying credits that are long-term leases in the properties with everything being greenlit, and we're able to make a much healthier return. I like that. And we're seeing that in the ABS market, in the roughly $50 billion that's been funded there. We're seeing that in the broadly syndicated loan market, in the high-yield bond market, and in the private credit markets. And so, whether it's private credit in IG or private credit that's non-IG, there's some really good opportunities out there. And the key is having the experience, setting up the right structure, amortizing deals, setting up the right covenants so you have a perfected interest in the underlying, and you can make a really good return with the right counterparty credits.
Does it tell you, though, something about where spreads are headed? If we do see a lot of these examples where investors are no longer just kind of sailing into every single deal, they are asking for more concessions.
Well, IG's out a few basis points. It's out to 82 basis points, but it's a mere little 82 basis points. It's still a very healthy spread. And the high-yield bond market is out to around 3.25, but double B high-yield bonds and double B broadly syndicated loans are rather tight in the high-yield bonds and the 200, low 200 spreads for double Bs. So credit is doing well. There is a crowding out, and you're absolutely right, Emily. There is a crowding out that's happening. It starts with the U.S. government that's running 6 to 7% deficits, that has to issue trillions of dollars, that's forcing long rates out. And in addition to the Fed and inflation, and we can talk about that later if you like. But there's a crowding out there, and there's a crowding out also with all this debt that's funding the data center AI build out. It's causing spreads in general to be a little wider. And so, yes, we like that environment because with a higher base rate or higher for longer and wider spreads, as credit investors, we're going to get paid really well for risk across the public markets and across the private credit markets.
I need your thoughts, though, on what we learned yesterday, or maybe not learned. It certainly had a pretty extreme market reaction yesterday on the longer end of the curve, a huge steepening, which seemed to suggest the market does not buy into, at least for right now, what the Fed's stance is on fighting inflation. Cost of borrowing going up for the Treasury. Does that exacerbate everything that you just said if that continues?
The hawkish hold that the market's characterizing this to be, I think is a misnomer. Really what we have at the end of the day is less transparency means more rate volatility. It's just that simple. And get used to this Fed, Marsh's Fed, having less transparency because he's going to telegraph left. He's doing away with the dot plot, so he didn't vote last time. By the end of the year, it will be dead and dormant, not to come back, at least in this next generation. But his biggest beef, I believe, his biggest beef is with the data set itself. And so the data is faulty. And the reason why the data is faulty, I know it's a big statement because no one's doing it ill-intentionally, but the data is faulty because the models and the weightings. And so why should used cars have this weighting and OER have that weighting? And why should it be surveyed by voice conversations with what people are charging on what? That's your inputs. So the inputs and the outputs are a bit flawed. And so what's really happening, and this is what's really happening, is Walsh doesn't want to raise rates if you don't actually know what the right inflation calculation is. And he's certainly not going to lower rates if you don't know what that is. And so right now inflation is somewhat well behaved. We're seeing some good trends in this last couple of months with respect to wages. We're going to get employment next week, next Friday, 75,000 jobs roughly. We see the GDP just came in at 1.5%, a little bit on the soft side. Right. Granted, a little bit due to exports and trade, but like a little bit softer. But with an economy that's only 1.5% GDP right now, and jobs that are steady, and inflation that's a little bit well behaved, the only part that's not well behaved is oil prices. And there's nothing that the Fed can do to control oil prices because that's determined by what happens in the Persian Gulf.
All right, Bruce, got to leave it there. Great insights as always. Bruce Richards over at CBC Marathon there, kicking us off to the close. A close eye on treasuries today, right now, more subdued, but a lot of activity in equities as we head towards the closing bells and earnings from Amazon and Apple. This is Bloomberg. Taking a look at shares of Robinhood, slightly lower on the day. The fintech platform seen a year-over-year decline in crypto trading volume, offset by record results in its options and prediction markets business. You put it all together, you still had a clean beat on both the top and the bottom lines, but a lot of questions about growth going forward. Who better to pose those questions to than the chairman and CEO and co-founder of Robinhood, Vlad Tenev. Great to see you, Vlad.
Pleasure to meet you.
The numbers are decent. I mean, let's ignore, for example, the 1.5% drop you're seeing in the shares here. I want to talk about growth and where the next leg of growth comes. You had a huge bump up in growth in the prediction markets business. I understand it's a new business, so obviously the growth would be there. Was that just sort of one-off in terms of the growth because of the World Cup and all the other things that have been going on in the world, or is that sustainable?
Prediction markets has been growing consistently since launch. It's the fastest growing business in our history. Well into the mid hundreds of millions of annualized revenue. So that's been strong, and we expect it to continue to be strong. We have football season on the sports side coming up, as well as the midterms, which, if you remember the origin of prediction markets and this current super cycle, it really started with the 2024 election. So we're expecting that this election is similarly going to be a big event. But, also, one of the stories of the quarter, Robinhood has begun to diversify, and that's accelerated over time. We now have 13 business lines generating over 100 million in annualized revenue, including Robinhood Legend, which is our pro trading platform, as well as the Robinhood credit card.
Well, that's what I'm curious about. I mean, because yes, it is incredibly diversified now. But when we look at certain growth, I mean, some people are wondering, does the prediction market become sort of one of the bigger parts of this business over time? Or is your goal to try to keep at least some of the main components of those 13 lines relatively in balance?
Yeah, the way we do our business planning is we have general managers that are running relatively autonomous business units, and they're
so you give them a lot of freedom to just to do.
They're goaled to make their businesses as big as possible and win in market share across each of these. So our goal is to be number one in all categories that we offer products to customers, and in fact there's a flywheel in effect, and it's actually continuing to expand. It's we get more customers. Those customers bring more assets onto the platform, and they become gold subscribers. They use more of our products, which gives them an opportunity to deploy their assets across all sorts of different areas. Retirement, they can spend with our card products. They can earn a high rate, including on our FDIC insured deposit sweep. Also, our Robinhood Earn crypto-backed product, which offers 7% APY. That's been growing really quickly. So we have all of these things that we enable you to put your money to work. And then those in turn bring in more customers. And now we also have advisors. So we have advisors joining the network. You can get a human advisor on Robinhood to help give you even more personalized guidance. The more advisors we bring on, that in turn feeds the flywheel and over time increases the number of customers.
Well, speaking of customers, you have now 7 million children about signing up for these Trump accounts. When do you anticipate that actually translates to more regular Robinhood users? I mean, not the baby that just got the account, but maybe their family members, a parent here. When does that actually contribute to more users?
Yeah, well, remember, the Trump accounts just launched earlier this month on July 4th, and it's been, Secretary Belton called it the most successful program launch in government history. And what happens is, given the tremendous success of the program, there's more and more things to build. We're growing it bigger and bigger. Donors are coming up. So I think this can become the default philanthropic donor solution. And we can collect all of the donors, which bring in more assets to the platform, because it gives a direct option for charitable giving. We're getting the employers on board. A lot of employers, including Robinhood and many other companies, are giving to the Trump accounts of their employees who are having children. And over time, we expect to go from 7 million children signed up to closer to the 70 million in the addressable market. And as the kids grow, when they turn 18, these roll over into traditional retirement accounts. So it's a long-term play. But we believe it's probably the most important thing we could be doing for the future of the country.
I do want to ask about one of your other lines of business, the Robinhood chain. I mean, we said in the intro the crypto business was down in the most recent quarter. You're building out a business that's effectively kind of built on the back of sort of crypto technology. Is this sort of a play towards not just crypto long term, but tokenization? Give me some sense here as to what you actually want this business to be.
Yeah, so tokenization is one of the areas that we're a leader in. And the idea is, when you say crypto is down, really a lot of that is just talking about the trading of crypto assets. But our view is that the future of crypto is that it becomes the infrastructure layer among trading all kinds of assets, including real world assets. Even though we're fans of memes, we also like real world assets. And so what we've done is tokenize stocks, put them on chain through our stock tokens product, and we're making them available to over 120 countries around the world. We also have a stablecoin lending product, which allows customers to earn 7% APY, and that's up to 200 million in balances in just a short number of weeks. And so even the crypto business line, if you look at it, is diversifying. There's now lending revenue, there's assets revenue, there's chain sequencer revenue from Robinhood Chain. So you'll see that get more diversified and less reliant on the day-to-day price of Bitcoin, for example.
The market volatility.
Yeah, absolutely.
Because it's happening. Vlad Tenev, great to see you. Thanks for joining us.
Always a pleasure to be here in person. Thank you.
Vlad.
That's Vlad Tenev, Chairman and CEO of Robinhood. And this is The Close on Bloomberg.
A couple of IPOs come into market. We were talking about Jersey Mike's earlier, but private equity-backed women's wear brand Reformation now trading in the public market after raising $211 million. And joining us right here on the heels of that debut is the CEO, Hali Borenstein, over at Reformation. Great to have you here in studio, too.
Thank you guys for having me. It's a big day for Reformation for our entire team.
Well, talk a little bit about what the growth story is going to be. Anytime someone has an IPO, I always like to ask them about the shift from being a private company and not having to answer to all the Wall Street muckety-mucks who are going to come bugging you every quarter to know what the next growth rate is going to be. You've had something like 20 consecutive quarters based on your S1 of decent growth on the revenue side here. Do you anticipate that continuing? And more so, do you expect profitability growth to finally come along with it?
So since day one, we have been this business that is really dedicated to redefining retail, to modernizing the role of a brand in fashion. And we think we've achieved exactly that. You're right, we've had very consistent growth, and it's been high quality growth. So we do have double-digit EBITDA margins. We are profitable. We did have some impact last year with tariffs, like many other businesses. But this is a business that has demonstrated its ability to perform both in the top line and in terms of profitability.
We'll talk about tariffs, or less tariffs, but more about sourcing of your clothes. Because I was kind of reading about kind of where things come from. And is it true, I read this, you can tell me, that you try on everything that at some point that you sell, or is that just made up?
I love to try on our clothing, I do, but so do a lot of people. Part of what we do really well is we make amazing clothing. And a lot of our team tries it on to make sure it makes women feel great. 84% of customers say wearing Reformation makes them feel confident. And as CEO, that makes me feel so proud.
So, but with regards to your supply chain, getting the materials, getting the actual product itself, how exposed are you to that cross-border tariff risk?
We've really built a globally diverse supply chain. So just last year, 34% of our units actually came from North America, which is pretty impressive for a brand like ours. So we think we've built some insulation. We also have very deep relationships with our vendor base, which is truly global. And so, you know, tariffs is certainly something we will manage, as will so many other companies out there. But we feel like we have the track record and the playbook now to do that more effectively as we go forward.
Reformation has been known for its, sustainability. Are you able to kind of keep that? Because you're going to be a bigger company, you're going to be expanding. How do you kind of keep that commitment to sustainability when you have presumably a lot more products that are going to be coming out?
I think it's important to understand what sustainability means to Reformation. So importantly, we never lead with sustainability. We make amazing products, and we never ask our customers to compromise on style, on quality, on fit. Instead, what we do is we offer unprecedented value to our consumer with product that does both. And that's why we believe we win. And for consumers where sustainability really matters, we see a major increase in their spending behavior. It's been embedded in our mission since day one. It's part of our decisions, our business practices, as well as our vendor relationships. And so we believe it'll be very easy for us to continue to scale with these principles, really bringing sustainable fashion to everyone.
Is your plan to continue basically selling on your own, direct to consumer through your site and your stores, or are you going to do more relationships with third parties like Bloomingdale's, Nordstrom, et cetera?
So at Reformation, we're 90% direct to consumer. 2/3 of that comes from our e-commerce site, 1/3 from retail. That will likely be more or less the mix over time. We're really excited about our DTC channel and how we can communicate our product and our brand to consumers. We have said we are going to double our store count over the next 5 years, and it's really important because it's a great business, but it also really helps us accelerate our overall DTC growth.
Thank you for joining us on your IPO day. That was Hali Borenstein, Reformation CEO. And coming up, the turnaround brewing.
We got to get her back to talk about these store openings. That's a lot of stores.
I know. It's a lot of stores. Brian Niccol, Starbucks CEO, is next. This is The Close on Bloomberg TV.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Emily Grafeo.
Keeping an eye on the broader market strength on the day. The NASDAQ 100 now up about almost more than 3% here on the day, but that's largely led by a relatively narrow cohort of technology names. Outside of the tech space, Starbucks shares are getting a bid, up about 2% here. This after the coffee company beat comparable sales estimates, boosted its earnings outlook for the full year, and the CEO says a lot more is to come. I had a chance to catch up with Brian Niccol just a little while ago about his turnaround effort and the start of pumpkin spice season.
The reality is what's terrific to see is the growth is coming from more customers coming into Starbucks more often. And, that's just a foundational strength. And the good news is we're seeing it across all income groups and really all age groups. So just really terrific strength moving through our stores.
With regards to the tickets as well, that was also up about 3.5% in the most recent quarter. So it's a function of both foot traffic coming into the store, but also people spending more. Are they buying more? Are these add-ons? What gets that ticket price up to that 3.5% jump?
Yeah, so what you're referring there is we're seeing people add more food, so a higher attach rate. And then what we're also seeing is people modifying more of their drinks with things like our cold foam, adding an espresso shot. So it really is terrific to see people using our menu to get them the customized experience that they want out of their drink, and then also attaching what is really some terrific food to go along with their beverage.
Do you have any concerns about maintaining this momentum? And I don't necessarily mean that from an operational perspective. We just got a GDP report for the second quarter, backwards looking, much lighter than what folks had been looking for. Consumer spending holding up right now, but you've referenced in the past that you had seen some strain, at least amongst the lower income consumers. Are you concerned that some of that weakness might be spreading beyond just the lower income folks?
You know, actually, we're seeing strength across all income groups at Starbucks. And, you know, what we continue to see is when we give people a great experience, they come back more often. And when we do it consistently, they really reward us with their business. And so, you know, we've not seen the customer move back as it relates to Starbucks. They've been really resilient. We're very optimistic about where we're headed. You know, we exited the quarter with really strong performance, and we're excited about how we're heading into our fourth quarter, and we're really optimistic about the plans we have for 2027. So, you know, look, we're just getting started. It's great to see the strength across all of these customer, you know, demographics, and we're confident we're going to continue to have success with them.
Well, let's talk about 2027. Obviously, we've seen the revenue numbers, at least I say the sales numbers start to come up a little bit. There's still some concerns about whether we could see more meaningful profitability. How much of the lag between those two is tied to the revamp of the stores? I mean, you've done 1,000 so far for this fiscal year. I think you're, still guiding towards 1,500 for the next fiscal year. There's a huge cost attached to that, right?
Well, you know, look, I think the thing that we've done here is we were really smart about what we spent on these uplifts and the implications on the store. So, you know, we can do these things for roughly $150,000. We do not close the store at all, so operations continue to perform. And then the experience that our partners have, because now they've got a new, really great looking coffee house, and that what our customers have results in, you know, frankly, more transactions. So it's been a great program. We'll continue to push the program forward. We're going to accelerate it into 2027 because we know when we create a great coffee house and we have that great partner / barista to customer experience, we're rewarded with more business. And, you know, it's not a big investment, but it's a meaningful investment, and then it gets us great results.
I know there was some color on the conference call about some of the time that you shaved off of that. We're talking seconds here, but it seems like those seconds matter to you. How much progress have you made?
Yeah, look, this is one where I'm really excited because we set out right from the go that we wanted to improve the speed that our customers experience, and then do it consistently. And kind of behind that is really this drive towards more throughput. And we've seen just that. So we've got better throughput in the mornings. We also have better throughput in the afternoons. And frankly, as a result, all day long, our transactions are up throughout the day.
Is there any conflict, though, with getting that number down in terms of the time down and this idea of these add-ons and other things that I would assume would complicate the process for the baristas just a bit?
Yeah, look, we're very intentional. So, you know, so everything that we do, we have an eye towards what is the implication on our ability for our customers to get the product, the food that they want in the speed terms that they desire. And we also have a really close eye to make sure that our partners are set up to be able to provide the customization, the drink, you know, the craft, the way that they would want to do it themselves. And so, you know, that is part of our development process, and that's part of the rigor that we go through to make sure before it gets to the store, it's been vetted such that we know we can still deliver on the great experience at the speed that our customers expect.
You've introduced a lot of new products. I know you even talked on the conference call about a s'mores drink, not necessarily my bag, but I can understand why some folks might like it here.
Have you tried it? You need to
not
try
yet,
it.
Not yet. I have tried the orange cream, and it is good here. But, and look, I mean, probably the s'mores drink isn't targeted towards my demographic. I mean, you've clearly gone after the younger demographic with the Gen Z, the pink drinks, the s'mores, et cetera here. But with these types of drinks, you know, the complexity that maybe adds to the process, but also this idea, if these aren't going to be permanent menu items, just sort of limited time offers, do you run into sort of some issue in terms of sort of how you forecast out comp sales growth if you know s'mores might be gone in, you know, whenever, a few weeks or whatever?
Yeah, look, I think the menu innovation that comes out as like limited time offers versus the menu innovation that ends up being permanent on our menu they serve two different purposes. And yes, we're able to forecast this with accuracy. I mean, as a result, I think you saw in the release, our supply chain, we're 99% of the time in stock with the items that people want. And I think if you look at our beverages, it's almost close to 100%. So we are able to forecast correctly, supply it correctly, and then most importantly, we build it in such a way that our partners are able to do it consistently and give people the experience that they want. You know, and as you mentioned, like the orange cream cold foam that's going on, the cold brew. I mean, look, the good news is, yes, it's orange cream, but it's exactly the same way that we always do cold brew. It's exactly the same way that we always do cold foam. So the consistency, the standardization of the build so that people can get to the quality experience that they want at the speed that we know they desire is really important to the work that we do on this.
I do have to ask you, Brian, about a report that Bloomberg had about 3 weeks ago, citing internal documents that you were actually looking to replace some of your in-house software tools, particularly those made by Microsoft and IBM. Your chief technology officer has talked a lot about how he can maybe get some of those software costs down. Any credence to that report?
Yeah, look, I think you would expect us to be looking with a critical eye towards any product that we use and whether or not we're getting the best cost proposition, and also are we getting the best outcomes from that proposition. And that's basically what we're doing here is we've got some great partners, but at the same token, we need to make sure that we are getting the best output for the best pricing. And I think, you know, as probably everybody's doing with the advent of AI, it gives you an opportunity to rethink what we're doing and how we're doing it. And, you know, that's literally the exercise that we're going through. And I think you would expect that from all organizations to have the cost discipline tied to making sure that you're getting the right outcomes that you want.
Well, that cost discipline has obviously also increased the amount of cash you have on hand. At the same time, your debt obligations are down. Where's that cash going to go? Is that next dollar going to go to buybacks? Is it going to go to acquisitions? Is it just going to go back into the stores?
You know, so the good news is for us, as the business continues to recover, you know, the balance sheet gets stronger and stronger. It gives us terrific opportunities to invest in growth. Obviously, some of that growth is going to be the store remodels and then obviously building new stores. And then we'll look around to figure out what is the right next growth vehicle for us. You know, buybacks may be part of it. Obviously, we've got a dividend that, you know, has always been there. So we're always thinking through what is the best way to deploy that cash so that we get growth in the business and get a great return for our shareholders and all of our partners.
Hey, Brian, appreciate it, but I need you to do one last thing for me and settle a debate that my niece wanted me to ask you. When officially does pumpkin spice season start?
It's coming. Get ready. We're not too far away, so I'm anxious for it as well.
Brian Niccol, of course, the CEO of Starbucks, answering all of the hard-hitting questions. Now we want to continue here with our earnings coverage. We go from Starbucks to cargo. Logistics services provider XPO out with their earnings, beating EPS estimates for the second quarter and making progress towards better margins. Joining us right now here on The Close is XPO CEO Mario Harik. Mario, great to have you here on the program. The numbers look good. Talk to me about operating ratios. Talk to me about the cost cutting. Talk to me about the efficiencies, Mario. That's what the market's been focused on. So far, you've been able to deliver on that the past few quarters. Does that continue?
Well, absolutely, Romain. We had a fantastic second quarter where we were able to improve our operating margins by 300 basis points. And for the first time in our history, we got to an operating margin over 20% here in the second quarter. And that's driven by a combination of an accelerating demand environment and accelerating volumes in our network, but also accelerating pricing and accelerating efficiencies. So these three components, it was has enabled us to deliver on these kind of numbers and growth.
Give me a sense here on sort of what we're seeing with regards to economic conditions. We had a GDP report this morning, backwards looking, of course, but it gave us a sense that maybe the economy a little bit softer than what some folks had thought. But I'm taking a look at your tonnage. It looks like you came out of June up about 4%, and that July, correct me if I'm wrong, is tracking at more than 6%. What does that tell us about what we should expect for August and beyond?
you're spot on the numbers. We have seen an acceleration of demand in our network for our services here through the second quarter and into the beginning of the third quarter. But a portion of that, Romain, was driven by our own company-specific initiatives. Here in the second quarter and over the last few years, we've improved our service product for the customer tremendously. So we're being able to gain market share, especially with small to medium-sized customers. Now, this said, we're also starting to see early innings of a recovery from an industrial demand perspective. Now, keep in mind, we've been in what is known as a freight recession or an industrial recession in our country over the last 3 years. So there has been a pent-up demand. And more recently here in the second quarter, we started to see manufacturing pick up, especially in the Midwest, the middle of the country, where we are seeing that the demand in that part of the industrial sector starting to pick up through the second quarter and early in the third quarter as well. And all of these, along with our company-specific initiatives, have enabled us to see this acceleration in overall demand.
Well, industrial, we've seen in the manufacturing, we've seen that kind of strengthen for obvious reasons. I'm curious about the retail side and what your customers are telling you and whether there's something that maybe you're able to glean that isn't quite showing up in the official government data yet on the economy.
Well, on the consumer side or the retail side, it has been positive through the course of the year, but just modestly positive. So we haven't seen it either take a step back or to take a meaningful step forward. It's been slightly positive here through the course of the year and the second quarter as well, in terms of that portion of the demand environment. But as you said, the industrial side has been in a depressed state for the better part of 3 years, and now we're seeing that starting to pick up. We're even seeing the ISM manufacturing index being over 50 here so far year to date is an expansionary type environment where we are seeing again more of that industrial demand pick up through the course of the year. In terms of what our customers are saying, there's much more optimism today than there was when we started the year. We do a survey every quarter with our customer, and here in the last survey over the last couple of weeks, we have seen double the number of customers now expect an acceleration in the back half of the year relative to the survey we did at the beginning of the year. So there's a bit more optimism from our customer base as well about an acceleration in demand in the back half.
So you talk about, how the broader industry has been in a freight recession. Can you identify kind of what the bottleneck really is for the broader sector to kind of get lifted out of that finally?
Yeah, so what we have seen is by interest rates being higher over the last few years, that curbed the overall amount of capital that people were deploying in buying industrial goods. But after a period of time and with interest rates coming down last year, we have seen that pent-up demand now starting to show up in the numbers where you had multiple sectors earlier in the year, for example, the industrial for the chemical industry, for agriculture, for heavy equipment, were all positive on a year-on-year basis. We did also see that the electrical manufacturing industry has been positive for the last few years and continue to see positive. And now we're seeing the manufacturing side of the industrial complex here improve in the end of the second quarter, heading into the beginning of the third quarter. Now, that's all still driven by pent-up demand as opposed to it being driven by new levers. But over time, we believe that you're going to start seeing that recovery more broadly. It could be next year, could be the back half of this year, but we're starting to see more optimism from the customers as well.
I just want to talk, we only have about a minute left, Mario, but just long term here. This is your business now. Brad Jacobs, who of course has been associated with this, is now fully sort of phased out his formal role, at least with the company. This is now Mario's company. No apologies to Brad. But I am curious about how you sort of position yourself up against the competition, whether it's Amazon's push into freight and LTL, whether it's the FedEx freight spinoff. There's a lot of players out there all going in different directions. How does XPO fit in long term?
Well, high level, Romain, we have a fantastic plan ahead of us to meaningfully improve our operating margin. So if you look at it over the last few years, we were the only carrier who was able to improve operating margins dramatically in the context of a freight recession. We also invested meaningfully into our network. We added 15% more doors to our network. We added more than 30% more trailers to our network and 20% more trucks. And all of that capacity was in the context of being able to support our customers whenever the freight market starts recovering. So we have a massive runway over the years to come to improve our operating margins by more than 1,000 basis points as we execute on our plan. The second component is cash flow generation. Just this year alone, we expect to more than double the amount of free cash flow we generated versus last year.
Wow.
And we expect to generate billions of dollars of free cash flow over the years to come.
Yeah.
And that's going to compound our returns to our shareholders as well over the years to come. So it's a fantastic plan, and we look forward over the next few years.
Thank you, Mario. We'll catch up again soon. This is Bloomberg. Just about 10 minutes until we get to the closing bells here in New York. I'm Romaine Bostic.
And I'm Emily Griffeo. And it is a day, Romaine, when we have big mega cap tech earnings coming out.
Again.
Just
Do you remember
after
yesterday? You were here.
I was here
crazy.
yesterday.
Yeah.
It was crazy. And it's about to get crazier in the next 10 minutes. Let's take a look, though, at how markets are trading. In these last 10 minutes, we do have the S&P 500 higher, up about 1.7%. The standout, though, is the chip trade. The Philadelphia Semiconductors Index, the SOX, up 8%. Now, it's still down 20% for the month, but some much-needed relief here for those chip names. Is it momentum, though, or is it actually linked to fundamentals? We did have some positive earnings from some chip names overnight, so we'll have to see if it holds. I also want to point out the yield curve here. Still a steepening. We had a benign PCE report, and yet traders kind of still doubting whether the Federal Reserve actually has a handle on controlling price pressures. We do have that 2-year yield down now to 4.2%, but the 30-year moving up just a hair. It's hovering around the highest levels remain since 2007.
Absolutely. And some of the moves that we're seeing in the equity space are phenomenal. It's funny you put up that SOX there, up 8%. That's the biggest one-day gain we've seen on that index, going all the way back to some of the Liberation Day volatility back in April of 2025. Meanwhile, a lot of volatility potentially up ahead with two big earnings reports after the bell, Amazon and Apple. Let's bring in John Belton, portfolio manager and managing director for growth portfolios over at the Gabelli Funds. And one of your main growth funds there, the Gabelli Growth Funds, holds a lot of these names. First of all, congratulations on Microsoft. We didn't even mention that. Having its best day since 2008. And I think I saw somewhere it's going to be the biggest addition to market value on a single day, single stock basis ever. But I need you to look ahead. What we learned from Microsoft last night, John, can we apply some of that to maybe what we should expect out of Amazon?
Well, yeah, thanks, Romaine. And I do think some of that result is being pre-traded in Amazon today. Last I looked, Amazon up 5-6%. I think expectations have clearly crept even higher for AWS in the quarter, for better or for worse. I do think Amazon should have strong numbers, particularly on the cloud side. Unclear if they're going to be good enough to support the stock tomorrow, but Microsoft, another mega cap company with really strong fundamentals that's been kind of cast aside, lagged the market. I feel like Amazon, hopefully there's similar dynamics.
Well, give me a sense here, because, I mean, you're aware, obviously, of all of the hand-wringing that we've had over the last few weeks with regards to the hyperscalers and what they've been spending. The narrative, at least with Microsoft, and to a certain extent with Alphabet last week, was this idea that everything they're building, to a certain extent, is going to be of use, whether it's directly for AI data centers or something else. The idea there is that the capacity that they're building out certainly has a need, a demand. There's somewhere down the pipeline there. Does that apply to all the hyperscalers, though, in your view?
Well, I think Meta is the one that doesn't have a cloud business, and maybe you take that one separately. But I think for the big three cloud hyperscalers, for Amazon, for Microsoft, for Google, these are businesses with significant compute needs in their core businesses, whether that's digital advertising or e-commerce, or whether that's the productivity apps that Microsoft offers. And there are also businesses with significant compute needs in their infrastructure as a service businesses. Meta is a little bit different, doesn't have that cloud services business, but I think it was interesting to hear Mark Zuckerberg last night frame some of the opportunities he sees to start monetizing some of that compute down the road.
I mean, John, when you think about just how much these companies have already projected they're going to spend on the AI build-out, how are you feeling as an investor if some of these companies come out and continue to raise Capex forecasts? Is that a worrisome sign?
Well, this probably isn't a great answer, but the first thing I look at is how has the Capex that's already been spent done? And I think very clearly for each of these companies, for Meta included, if you look on a trailing basis, the return on invested capital on this Capex has been substantial. It's in the numbers. It's just a fact. Now, the Capex plans are, as you mentioned, continuing to ramp from here. And so the question is, the market's always forward-looking. Are the returns on future Capex going to match what they've already generated to date? And, I think Microsoft did a good job last night showing the acceleration across different parts of their businesses that's stemmed from this Capex. And I think there's a lot of encouraging signs. But, yeah, I think, you just have to take it day by day.
We have the 30-year yield above 5.2%, and yet we also have the NASDAQ 100 up over 3%. Is it a sign to you that these mega caps can actually withstand an environment where rates are higher for longer?
Right. Well, I mean, there's a lot of dynamics happening with the Fed and with Kevin Warsh's second meeting yesterday. I personally think that meeting was, a positive for risk assets, just in the sense that new Fed chairman didn't act in an unpredictable way. I think a lot of the other dynamics are debatable, but I think in that environment, there can be a bid for stocks so long as fundamentals are there. And what are you seeing today? A stock like Microsoft lifting the NASDAQ 100, that's up on very good earnings. One of the best earnings reports I can remember from Microsoft in many years. So I do think fundamentals in the case of a Microsoft today are driving the stock.
You guys are also holders of Apple. I do just have to ask you what your expectations are. It's kind of been a nice stealth stock over the last few weeks here, as I think a lot of people finally gave it credit for its sort of tortoise approach to the AI race, but they've got a big CEO change coming up and a big slate of products set for the fall, including a flip phone that our Mark Gurman is very excited about.
Yeah, Apple, I think everyone likes to say, Apple's only outperforming because it's the Capex light mega cap. I think if you look at the numbers, Apple's had several straight quarters of really strong results, particularly on the iPhone line. Services also remain strong, but I think Apple, coming off a couple quarters of huge iPhone numbers, I think we're clearly in an iPhone replacement cycle. I'm expecting more strong iPhone numbers today, strong iPhone revenue guide. We'll hear how bad or how concerned they are on the gross margin side from some of these component cost increases, but I think Apple should have another strong quarter of fundamentals.
All right, John, always appreciate you taking time for us. John Belton there, portfolio manager, managing director for growth portfolios over at Gabelli Funds. As we keep an eye on the broader market, Emily, up about 3% on the NASDAQ indices, both the NASDAQ Composite and NASDAQ 100. The S&P now back near session highs, up about 1.7%.
I mean, these are companies that are dominating the market. They've been part of the trade, and it's all going to come to a head, Romaine, in the next few minutes here when we do expect some of these mega cap earnings to come in.
Yeah, and we should point out we're going to get quite a few earnings after the bell from names now other than Amazon and Apple. We'll break that down for you. But of course, Amazon and Apple, that will be the star of the show. We'll have full breakdown and full analysis starting right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Emily Grafeo taking you through to that closing bell. It's a global simulcast. Carol Massler, Tim Stenovec, they join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio. Our partnership with YouTube, Carol Massler, where the word of the day is Inner Mongolia.
Oh, are you talking about the latest data center?
No, Carol Massler.
I thought the word of the day was Microsoft.
Well, Microsoft having a phenomenal day. I hope that ended up on Carol's gainers board today.
We may never find out.
Yeah.
We may never. Yeah. I mean, listen, you're talking about what? That they are maybe adding almost $500 billion in market value, which would be remarkable in terms of what we've seen. But look at, S&P 500 higher, but again, here's a day where the indexes are moving ahead, but most names in the S&P are actually lower for the day.
I hope I'm not stealing some of Carol's thunder here, but Microsoft shares were up 17.5% earlier. If we look at just how this looks in the context of history, this is the biggest increase for shares of Microsoft going back to October of 2008.
You just want to do gainers, don't you?
I have another
Carol,
gainer,
when you're out,
too.
I do gainers.
I'm surprised we haven't said the word socks yet, because the semiconductors index is on fire today. It's up over 8%. And the names in there, they're not the mega caps. We have Micron, AMD, Broadcom. It's all those chip names that have been selling off. They're coming back today.
Obviously, Microsoft giving a big lift to this market on the back of the earnings report yesterday. That seems to suggest that all of that Capex spend, that yes, indeed, Virginia, there is a Santa Claus when it comes to the return on investment. We're going to hear from Amazon in just a minute. It'll be interesting to see what they have to say. Apple a little bit later. We're also getting earnings this afternoon from Coinbase, Illumina, as well as Strategy and Roblox. Screen across the screen with the S&P up more than 100 points or 1.7%. The Dow up more than 600 points or 1.2%. The NASDAQ composite closes out the day up by about 2.8%. The NASDAQ 100 up 3.4, Carol, and the Russell 2000 in on the action with a gain of 1.4%.
Yeah, really a bullish tone to the market. Going back to what I said at the top, I've got to do it. S&P 500, Emily, more than 300 names actually losing ground in that index, yet 197 to the upside.
And you can really see the strength in the market, at least for the tech names. The information technology sector of the S&P 500 up 5% versus some of these other sectors in the red here. Communication services, consumer staples, healthcare, real estate, utilities. The breadth was kind of a mixed bag. Really, the story was that tech was driving the index, at least for today.
And I just want to point out, too, I know we might not get to the decliners, but Meta down 8% on the day, about a 20% slide, more than 20% slide over the last 11 sessions. And that's a big sort of the story here as we got those Microsoft earnings, which did show some sort of proof of life when it comes to the AI spend. Meta at least did not show it, at least in the view of investors. The question is, will Amazon show it? Those earnings crossing the wire right now. Net sales, $200.6 billion. The street was looking for $197. Amazon Web Services net sales, $42.23. That's a beat. The street was looking for $40.57 billion on that number. And even when you X out the XF, that's still about 37% jump year over year. Operating margin overall for the company, 13.7%. That's above street estimates of about 12%. Here's the forecast for the third quarter. Amazon says expects net sales overall of $197 billion to $202 billion. That actually looks a little bit light on the top line. The street on average is looking for about $204 billion on average. As far as the bottom line, the company says, actually, I'm going to skip the bottom line there for a second, Carol, but we need to dig a little bit deeper into the AWS numbers to see how things are going.
Yeah, absolutely. And, just looking to the headline, we're just kind of highlighting this third quarter net sales forecast, missing estimates. Even so, though, right now investors seem pretty impressed. That stock is up about 6% here in the aftermarket, Tim.
Yeah, Amazon free cash flow fell to an outflow of $7.6 billion for the trailing 12 months. Shares jumping 6.5% right now. Third quarter net sales, 197 to 202. The estimate was for $203.93 billion. Just some commentary coming from Andy Jassy, who talks about the growth of AWS and highlights the growth of AWS, noting that AWS grew at 36.7% year over year in the second quarter. It was the fastest growth in 18 quarters. In the AI and chips business, each eclipsed run rates of more than $25 billion. Amazon shares up about 8% in the after hours.
Yeah, just going through some of these other results here for Amazon. Second quarter North American net sales actually above estimates here, $116 billion versus estimates of about $113. Physical stores net sales missing estimates just slightly, $5.79 billion versus estimates of about $5.87 billion. Again, doesn't seem to be affecting the shares. The focus here really on that net sales beat. It is a stock that is moving quite higher in the post-market, Romaine.
Yeah, I'm still trying to look through and see if we can get a little bit more clarity on the backlog here, because that, of course, is what a lot of people are focused on with regards to AWS, and a beat on that particular segment number. Those operating income numbers that I was trying to get to, this is for the company as a whole. The company says that for the current quarter, it does expect operating income of about $22.5 to about $26.5 billion. The street was looking for about 25. So basically, basically, it looks like these numbers for the second quarter as well as for the third quarter are right around to slightly above, and in one case, slightly below what the street is looking for. But Carol and Tim, what everybody really wants to know here is just how much further this Capex spend could take AWS and whether there is a return.
But I'm curious about why this net sales number came in light. And
I don't know either,
Yeah, 197 to 202. The estimate was for 203. So basically, the estimate is for 204. Even at the high end of the guidance, it's shy by about $2 billion. I'm going to be interested to hear about what that is attributed to and why analysts didn't get what they want.
I just want to say, too, sorry, Carol, just real quickly, because I was looking at the backlog. We're now getting the headlines here for the AI and chip segment that a lot of people have been focused on. Amazon is saying that it's exceeding $25 billion annual revenue run rate for AWS's AI unit. So a unit of a unit on a $25 billion annual revenue run rate. I know run rate is a dirty word for some people, but you got to just take it as you see it for right now. The company's saying that AI and chips each eclipse run rates of over $25 billion.
Here's what's kind of wild. You don't think of Amazon as a chip company, right? And we know increasingly all of these companies are certainly getting more involved in all of this, but to get that kind of a number on it is pretty impressive. I just want to go to something that's in the press release. Just gives you an idea of what this company is thinking. They announced an investment of $1 billion to create AWS Forward Deployed Engineering. So it's a team of AI engineers embedded directly with customers to co-develop and deploy agentic AI solutions in days rather than months. Early customers include Allen Institute, Cox Automotive, the NBA, the NFL, Ricoh, and Southwest Airlines. The way AI is kind of invading, in a good or bad way, our world, and these companies, their involvement, to give an idea of where that money is going and where the ROI might be coming in the future. I just think it's kind of interesting.
And as a credit girl, I am, of course, really interested. My sources are interested in whether we're actually going to see an ROI on all that spending. Just a reminder here, the company has sold $62 billion of bonds in the U.S. this year. This was a company that really was not raising any debt. They didn't really need to for the longest time, but that just goes to show their commitment to spending and building out artificial intelligence.
All right, we're going to continue to keep an eye here on Amazon and dive a little bit deeper into those numbers. We're getting some other earnings as well, including Roblox, which is down about 10% right now. Coinbase, the share is kind of fluctuating along the waterline here as their results now crossing the wire. The company's revenue numbers missing ever so slightly, about $1.22 billion. The street on average was looking for about $1.29 billion. There's a bigger story going on here. Need a little bit of time to get through the release. Carol.
All right. In the meantime, let's go to Rivian coming out with its latest results. Second quarter revenue, folks, a little bit better than Street was looking for, $1.66 billion. The Street estimate was for $1.52 billion. Second quarter loss per share of 63 cents versus a loss of 97 cents a share year over year. Second quarter vehicles delivered 12,194. The Street estimate was for less than that, of about 11,471. And just for the outlook, still sees fiscal year vehicles delivered 65,000 to 70. Sees fiscal year adjusted EBITDA, Emily, loss of 1.8 to 2 billion. The estimated loss was for 2.01 billion, guys. And the stock right now up about 1% in the aftermarket.
Let's talk. Oh, go ahead, Emily.
All right, just so we're keeping an eye on this, too. I do want to just go back to Coinbase just real quickly here, guys. I was looking at those transaction numbers. They are well below street estimates, $599 million for Coinbase, 2Q transaction revenue. The street was looking for 635 there. So that kind of gets to this idea of why you had the slight miss on the top line numbers. And we were speaking with Vlad Tenev over at Robinhood earlier. Remember, obviously, that's a much more diversified company, but their crypto business did not do well. And that was a lot of questions here that with the price of crypto, particularly Bitcoin, depressed, that was weighing on trading activity. In the same note here, we are getting earnings out of Strategy here. Their revenue basically on the nose, in line with estimates at about $122.4 million of cash and cash equivalents, coming in a little bit light at 1.7. So Coinbase down, Strategy down ever so slightly there. We're getting some other earnings as well. Emily.
Yeah, Romaine, we're also getting Reddit here, third quarter revenue forecast beating estimates. They do see revenue $860 million to $870 million. That was versus estimates of $829.4 million. The stock, though, down in the after hours, about 3% right now. Just looking through some of these other results, the second quarter revenue also beat estimates, up 61% year over year. So might kind of take a little bit of digging here to see what's weighing on the stock. Daily active users, just a slight beat here, 130 100.3 million versus estimates of about just 130 flat here.
All right, guys, just back to the big one, Amazon, as we await Apple. That'll be out in just about 20 minutes or so. Amazon shares, we continue to see that stock up about 5.6% in the aftermarket after second quarter AWS net sales topped estimates. On to the call with analysts to see more commentary that we get around this beat, but certainly a pop here in the aftermarket. And then, as we mentioned, we're going to get Apple at the bottom of the hour. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Emily and Romaine, of course, they are on the close on television. And, of course, Tim and I back here on Bloomberg Business Week Daily. Folks, we will see you again, same time, same place tomorrow.
And we continue to keep our eyes here on Bloomberg Television on shares of Amazon, now up about 6% in the after-hours trade. The results just crossing the wire moments ago. Second quarter sales for Amazon Web Services up 37% year over year. That's about 6 percentage points higher on a growth basis than what the street was looking for. Net sales for the company as a whole, we'll call it $200.1 billion if you want to be precise. The street was looking for about 197. Free cash flow does go negative on a 12-month trailing basis here. But as you can tell, investors don't seem to care. It's all about the future, the backlog, and of course, AI and chips, $25 billion run rate, at least according to Amazon. Gil Luria, he joins us now, head of technology research over at DA Davidson. And Gil, you're smiling. Is that because you just looked through this report?
Yeah, the AWS result is nothing short of remarkable. It's not surprising because we got the good news from Google Cloud last week and from Microsoft Azure last night. But for this business is now at $170 billion a year run rate. To be growing 37% from 28% last quarter is an incredible acceleration. And that 25 billion of AI revenue, that's real. When we talk about are these companies getting a good return? Yeah, $25 billion of annualized revenue at probably 35% margin. That's a very good return on that Capex. Now, I didn't see Capex guidance in the release, but assuming they don't give us too scary of a number on the call, I would expect Amazon to hold on to these gains.
Well, yeah, I mean, that was the first thing that I did Control F4, sort of looking for that, trying to figure out whether they were actually going to mention it. And I guess that will be the bugaboo. But I am curious, when you look at the products that they have being developed, the ones they already have there that they're trying to grow, and they go through this one by one through the release, is there any sort of way you would actually bet against them finding a way to capitalize on that Capex?
Right now, they're doing a very good job of capitalizing on it because they're not just offering the AI compute, they're offering their customers all the software that comes on top of that, the control plane and the orchestration layer and the harnesses and all the software that you need, because buying an Anthropic model is not enough anymore. You need to make it work for your business. And Amazon, just like Microsoft yesterday, is doing a very good job of selling their customers that product set. They don't have to have the frontier model, but if they help their customers, their business customers, use the frontier models well, they're adding value and they're capturing the value in their results right now.
Amazon free cash flow falling to an outflow of $7.6 billion trailing 12 months. What do you make of that?
That had they reported a week ago and Google reported today, they'd be getting punished for that. But the market had a week to digest the fact that Amazon will have negative free cash flow. And so that was already in the stock. People understood that that's where they were headed. And so there's less of a concern about that. There's an understanding that Google, Amazon, and Meta will be cash flow negative. The standout is actually Microsoft that said they will remain cash flow positive, which is why they got rewarded even more handsomely today in the market.
I am wondering also what you make of just how the company is going to be able to compete for cloud customers going forward in an environment where they're not the only, leader in cloud and AI going forward.
Well, that was about a year ago. We were worried about that. We were worried about Microsoft and Google running away with it. But AWS's 37% growth is actually as impressive, if not more impressive, than the growth at Google and Microsoft, because it's on a much bigger scale. They're the leader, they're the incumbent. A year ago, they hadn't found their footing. The key to Amazon, just like the key to Google's growth last week, the key to Amazon is that Anthropic is such a big customer. Amazon is providing most of Anthropic's compute, and that huge ramp in Anthropic results this year is flowing through Amazon Web Services. That's why they have this accelerating growth, because they were wise enough to invest in Anthropic early on and secure that Anthropic used their compute.
Gil, before we let you go, I do just have to get your thoughts. We are still awaiting the earnings later this hour from Apple. Obviously, a much different AI story, if you will. But when you start to think about the strategy that they've taken so far under Tim Cook and about a month's time under John Ternus, give me a sense here as to where they fit in your view, in this AI race.
Well, they have it figured out. The reason Apple is trading at such a premium to all the other mega caps is because they decided they're going to stay above the fray. They're going to let others figure out what technology wins, which frontier model, how it's going to be used. They're going to continue to provide access to any of those models through their system without having to invest these hundreds of billions of dollars to build out the infrastructure. They're going to let other people do that, fight it out, and then eventually we're going to be using whatever the best model is through our Apple devices, our iPhones and Macs. That has turned out to be a fantastically good strategy, especially because it makes investors feel like, I don't need to know the answer to which model is the best. I'm going to be using it through Apple anyway. That's why Apple is trading at such a nice premium to all the other mega caps.
Gil, always a pleasure. Thank you. Gil Luria, head of technology research over at D.A. Davidson. Shares of Apple slightly higher in the after-hours trade after being down in the cash session. Amazon, which rose 5% in the cash session, looks like up about 5 or 6% here, or now 8% in the after-hours trade as we wait for that conference call to start at the top of the hour. We do want to stay in the AI space and bring in our next guest, who has spent the last 15-plus years investing in early growth stage companies in the software and tech space. Cheryl Cheng, managing partner over at Microsoft's M12 Ventures. And Cheryl, I want to get your thoughts here on this idea of kind of this narrative that's playing out in terms of the kind of, who's paying for AI. You kind of have, Apple paying a lot more for memory and all these things. You have the Amazons and other companies out there paying a lot to invest in their own capacity that, in theory, they're then going to sell out here. I am curious, are we looking at this all wrong in terms of like, which layer wins and who's going to be up on top? I mean, explain the ecosystem right now and where everybody fits in.
Sure. Well, it's great to see you again. Thanks for having me. So there's going to be a lot of layers that win. I don't think it's going to be only the chip companies will win or only the model companies will win. Really, what we're seeing is as enterprises adopt AI, they're going to want that sovereignty over the types of chips they use, the type of infrastructure they use, and the types of models and applications that they use. So really, we're in the early innings of all of this, and we probably will see a lot of different layers of the cake be able to win as they penetrate more into the enterprise space.
Well, give me a sense here. I mean, you see in real time, particularly with regards to private companies and startups and where they're actually spending with regards to their compute budgets. Give me a sense. I guess are those spending levels still where they were and what we were talking about just a few months ago, in some cases a few weeks ago? But do you have any sense of kind of how they're spending it, and not just the total aggregate amount of cash they're throwing?
Yeah, so actually one interesting trend that we've seen in startups as well as in enterprises is last year it was all about getting adoption. It was getting your enterprise workers to feel comfortable using AI, use as many tokens as you can. There was this term that was bandied around a lot called token maxing. And what we found was this year, CFOs are really starting to clamp down and look for that ROI in the applications and AI that they're really using and deploying into their enterprises. So definitely everyone is sharpening the pencil. It doesn't mean that they're going to use less AI. It just means that they're really thinking about the ROI of every application and use of AI as they deploy it into different parts of their organization.
What does this mean for the future of these legacy software companies that have, been around for a long time? I ask as, someone who writes about private credit, an industry that made a huge bet on the fact that revenue streams from software companies are reliable and they are sticky. Is that changing in the age of these new AI enterprise companies?
I don't think so. I mean, I think we're, again, still in early innings of adoption. So you will see some lumpiness. You will see some companies with really, really fast growing quarters, and then other quarters that'll be a little bit slower as they're developing their pipelines. But I think that the AI adoption is here to stay because the ROI is real. The business models will look different, though. You won't see a traditional SaaS business model, and you will see these AI companies really be able to trade on the fact that they're doing real work. So that ROI, that consumption-based, performance-based business model will be able to take hold, and the companies that are able to demonstrate that ROI will definitely create very, very stable, long-term, enduring revenue streams.
I do want to get your thoughts just as an investor because, I feel like all of these companies, and I'm talking about the large publicly traded companies, they're investors too. Obviously, NVIDIA's invested in a lot, Amazon as well. They've basically become venture investors, taking equity stakes and credits and all of the revenue commitments there. Does that worry you at all? I mean, I'm kind of getting to this idea of this circularity and the idea that everything and everyone seems so interconnected. I mean, you sit right in the heart of where all this is taking place. Is it a concern for you?
It's not a concern. I think that even in the SaaS world, and traditionally, tech has always been very interconnected. I think it's more pronounced these days because we think about data centers, we think about token creation, and then the tokens then go into the applications, and then the applications are being used. So it seems very circular, and it is because, remember, a tech stack is all built on top of each other. So there's always some level of interconnection.
Cheryl, appreciate it as always. Cheryl Cheng there. She's managing partner over at Microsoft's venture fund M12, taking a broader look here at some of the trends that we're seeing in the investment space when it comes to the AI race with those Amazon earnings on the books right now. You see the shares up about 9% in the after hours trade. We're still awaiting that conference call, which starts at the top of the hour. But another unique story in the AI space, of course, is Apple. We are waiting those earnings, which are imminent as well. Horace, Dediu joins us right now. He's a founder of research firm Asymco. Talk a little bit more about what we're seeing. And Horace, I do kind of want to pick up where we left off with Cheryl, the idea that you have kind of one side of this AI equation spending a lot for memory and all of the other sort of inflated prices on all of the components and everything. Then you have the Amazons and Alphabet spending, billions, hundreds of billions of dollars on their data centers that are consuming all of this memory. I am curious as to which side of the trade, if at all, you think looks more attractive?
Well, I've been following Apple for over 20 years. I think Apple's probably the greatest story in computing we've ever seen. Of course, it's on the consumer side. Of course, it's mostly devices at this point. But they've seen a lot of change in the industry, and I think that they've hedged their bets on investment, as you pointed out. But I think that overall, having the customer base, 2.5 billion people, it's probably they're in the best position to distribute the technology as we see it coming down.
Is there a sense, when you look at this memory shortage and the sky-high prices that we're seeing along with it, that could course correct anytime soon? I mean, right now, when you talk to particularly some of the executives, they're still, pretty much talking 1.5 to 2 years out before they even talk about any sort of meaningful subsiding of all of this.
That's about right. I don't disagree with the 18-month time frame. A lot of the memory plants out there require long lead times. I don't see that changing in the next year or so. Having said that, Apple's unique. It's one of the largest buyers. It's not the largest. They have their own long cycles with respect to product. And I think that they want to get into a relationship with suppliers that is a long-term relationship. And I think they're also integrated to a certain degree, far greater. And as a result, I think they've been getting decent pricing particularly on the iPhone memories. But as we saw with the price increase about a month ago, the other products are getting hit right now with spot pricing, which is far above what they've typically budgeted for in the past. And so we're seeing price increases from Apple. We probably will see a price increase from the iPhone as well, but it will be probably in the 10 to 15% range. That's my estimate.
Apple's approach to AI has been a little bit different than some of the other stocks in the Magnificent Seven. What are you going to be looking for when it comes to AI in these earnings?
Well, I think Apple's not going to change their stance with this, with respect to investment. However, the new CEO has indicated through the last quarter's earnings that they are suspending or eliminating their net cash zero position, which indicates that they might be investing through acquisitions, possibly, to gain more assets in this space. We also might see something from John Ternus, which is more aggressive with respect to investment in R&D, as he is more of an engineer, if you will, more of closer to the engineering side of things. But I do believe that the sort of data center type of spending is not going to change very much.
Yeah, what about just kind of more on guidance more broadly that you expect from this company and these earnings coming out very soon now?
Right. Well, we had a significant warning in the last few weeks regarding margins, meaning that through price increases, we might be looking at pressure on margins. We have indicated from the last quarter, the guidance was at 48 plus, let's say, on margins, which is pretty much the highest they've ever had. So now we're very curious as to whether we're going to see something drop in earning during the call regarding the margins guidance, especially as the product mix is changing into the fall quarter.
Horace, really appreciate it. Horace Dediu, the founder of the research firm Asymco, as we wait for those earnings out of Apple, which are imminent, and who better to talk to than Mark Gurman, who leads our technology coverage here at Bloomberg and has been writing a lot, not only about Apple's big slate of upcoming products, but more importantly, a big changing of the guard. This will actually be the last full quarter for Tim Cook at the helm. I assume it's going to be his last earnings call, unless he wants to stick around for the next one when John Ternus comes. Just kind of frame this for us. I mean, you go all the way back to 2011 with the passing of Steve Jobs, a lot of doubts about Tim Cook's ability to shepherd this company, and at least in terms of what he returned to investors over this last 15 years or so, he delivered.
He delivered.
Yeah.
One of his first moves after taking over as CEO, this happened in March of 2012, about 6 months after getting the top job from Steve Jobs, was to initiate that share buyback program, to start giving shares back, to start investing in bigger waves as well. And it's really, honestly, it's an amazing time for a CEO transition to happen. They're doing this exactly when the product mix is about to be shaken up. New types of devices, foldable iPhones. They just launched this Apple Upgrade hardware subscription service that we're going to hear a lot about today. It's a really big deal. And Ternus
when
is
you say
walking.
The subscription, but that's the lease.
So this is the leasing program. And basically, they're turning the company into a subscription where you'll be able to own an iPhone by paying for it in perpetuity and exchanging it for new versions on an annual basis. This is how they're going to lock people in. Yeah. They floated around this $5 trillion market cap a few days ago. This is how they get to 10 trillion by continuing with these subscriptions and whatnot. So Ternus is basically being handed a layup here, walking in with this big product portfolio, walking in with this leasing program, walking with this market cap. Obviously, the memory situation is a headwind, but that's not really something he's dealing with anyways. That's all on the operations side, where they have a really strong team in place there. So today, I think it's all going to be about Apple presenting continuity, stability, and that everything is going to continue on the same path that Tim Cook had Apple on, even with Ternus transitioning 2/3 into the current quarter.
Mark Gurman brought a prop. He brought his orange iPhone.
The orange
That's
iPhone.
Apparently the hot thing right now, Romain.
Explain this orange iPhone to me, because is this like the status? So why does everyone have the orange one and not the other colors?
You know, in China, you know, a lot of people seem to think it's similar to Hermes orange.
Yeah.
Me personally, I mean, I've seen Hermes orange.
Yeah.
It's not Hermes orange, but that's what everyone seems to think. It's more like Bloomberg Terminal orange.
Yeah.
Right? It's kind of similar to the font we use here. they're replacing it next month, or I guess September, a little bit a month from now. Ternus takes the reins as CEO on September 1st. About a week and a half after that, they're going to announce the next iPhones, moving from orange to this cherry deep wine red.
How much are Ternus's fingerprints on this product launch?
All 10 of his fingers are all over this product launch. But that's honestly been the case for years now. I mean, he's been running hardware engineering, so he's led the development of every product at Apple for the last half decade. And entering this new AI age, this robotics age, needing new devices to make use of artificial intelligence, you want a product-focused leader. So, you know, unsurprisingly, this is all happening at the exact right time.
Can he successfully lead the AI strategy then? When it comes to kind of the software story, not as much the hardware story.
Everything I've heard is he knows Apple needs bolder, bigger products. The biggest issue for Apple right now for launching AI devices has been their software. That's been the gate preventing them from releasing some of these new products, home devices, wearables, and what have you. Siri AI is in really decent shape if you've used the new public beta. It'll roll out in mid-September. That's going to allow them to start releasing this new hardware that Ternus has been leading.
Well, I know we're looking very forward here. We're about to get the earnings report. What's the one number that you're going to look for when this report comes out?
The one number is obviously going to be margins. We're going to see the impact in the third quarter. And during the earnings call, they'll talk about guidance and the memory shortage, how that's going to continue into the coming quarters. So obviously looking at that. And here we go.
And see pricing power as well. And yes, we are getting these numbers crossing the wire right now. I'll start with the bottom line. EPS for the fiscal third quarter, $2.02 a share, a beat. The street was looking for $1.89. Revenue for the quarter coming in at $109.42 billion. That's also a beat over $108.85 for the quarter. Services revenue looks like a little light at 30.7. iPhone revenue 54.25, slightly above what the street was looking for, relatively in line on wearables. Operating expenses slightly higher than what the street was looking for. And one number I'm also interested in here, Emily, was actually the Greater China revenue. It did come in a little bit light, $18.8 billion. Street was looking for $19.5 billion. But obviously, the big question going forward isn't so much what these numbers look like in the third quarter, but how much they change over the next couple of quarters with the introduction of some of these new products.
Yeah, I mean, and if this quarter really, and the quarters going forward really is a product story here, then China is going to be important. There's a lot of competition in that market that I think sometimes American consumers forget about. Just going over some of those numbers again, Greater China revenue still, you know, a slight miss here. America's revenue, though, beating estimates, $45.78 billion. That's up 11% year over year, and also beating estimates. The shares, though, remain down 2%.
Gross margin in the quarter up about 25%, slightly above what the street was looking for, both in terms of the growth rate as well as the actual number. Mark Gurman of Bloomberg still with us here as we start to parse through these earnings. And, you know, relatively ho-hum report when you look at these numbers, and it seems a lot of people are looking forward. But is there anything that jumped out? And more importantly, Mark, when we get to that conference call at 5 p.m. and they're going to have to really start to articulate a forecast of some sort, what do you expect to hear from them?
Well, they essentially missed on everything except two segments. The good news is that they beat on iPhone. This is about a $11 billion year-over-year increase. They missed on services. But the iPhone is, everything is built around the iPhone, so it's pretty successful.
But why services? I mean, that kind of jumped out at me because I thought that was sort of the ballast for this company. No matter what was going on with hardware sales, the services was going to hold up.
Well, I mean, the good news is that this Apple upgrade service, I mean, that's going to continue to make things a subscription. But I do need to point out the Mac absolutely destroyed estimates, coming in, what is it, north of $10 billion? Yeah, so estimates.
Is that surprising? Because I felt like, I don't know, I feel like a couple years ago, we were all saying, the Mac was being written off, or was it just a refresh of these products?
Honestly, to be honest with you, Romain, when I saw these estimates the other day, I thought the $8.6 billion was a little light. The Mac has been having tremendous momentum because of their in-house silicon. And the good news is the person driving this Mac renaissance, that is John Ternus. I mean, he made his name at Apple for reinventing the Mac around these chips. The MacBook Neo is clearly a hot seller. The new MacBook Airs and Pros clearly a hot seller. So I think this is a good omen for Apple and his tenure, to be honest with you, plus the iPhone being strong. The iPad, it's been weak for years now because they haven't really done much with it. There'll be a new iPad mini in several weeks from now with a new display with the OLED. Wearables is light, like we talked about, services light, but if I'm an Apple investor, I'm liking the Mac number, especially because that's now like the AI machine of choice.
What do the investors want to hear on this earnings call coming up?
Oh, they want to hear strong guidance, particularly around gross margin. They want to know that these price increases are going to do the trick. I think the investment community is no longer of the opinion that these price increases are going to hold back sales. I think they're of the opinion now that it's going to hold margins steady or back at the corporate average, something around there, but also increase sales because the new iPhone 18 Pro and Pro Max, the new foldable iPhone, the new Apple Watches launching this quarter are going to drive a lot of demand. So we're going to get our first sneak peek of how meaningful Apple believes these new products launching in just probably 5 to 7 weeks from now are going to do, because this quarter is going to include a couple weeks of sales of those products. So definitely looking forward to any color there.
All right, Mark Gurman, Bloomberg's chief correspondent for Apple and consumer hardware companies. The shares slightly lower, down by about 2% in the after-hours trade. The conference call at the top of the hour, but in the moment, we want to bring in Tony Wang, portfolio manager of science and technology equity strategy over at T. Rowe Price. Apple, a top holding in his science and technology fund. And despite the initial knee-jerk share reaction, Tony, we came into today with this stock on a pretty good run, up more than 20% over the past 5 weeks, and that seemed to be everyone looking at the income statement, the balance sheet, the cash flow statement, and saying that, you know, when you stack it up against some of the other tech companies out there, it's pretty healthy. Does it still look healthy to you now that you've seen these numbers?
Yeah, I think the numbers are good. I mean, I think that what really matters going forward is the outlook. And I think about it in two vectors. Probably one is the iPhone and the upgrade cycle. And I think this upgrade program that they're putting in place could be really powerful. I think that people have been keeping their iPhones by about quite extended amount of time, and so this can nudge the upgrades for a better experience for consumers, and then also they can essentially refurbish those phones when they're traded in. I think the big part of Apple is that trade-in value is really quite good. So I think that plus the services and unlocking Siri and AI assistant, I think those are the two things I'm looking for.
Well, talk to me a little bit about Siri, and we're going to ask Mark about this too, because he's been covering this a lot here. But when we talk about their use of AI and the AI tools that will be available in that ecosystem, are you comfortable with the strategy, at least based on what's been publicly reported? Are you comfortable with the strategy that they're taking on that, which seems to be a little bit more reliance on third parties?
Yeah, so it's a very capital-light strategy. So I think that's pretty differentiated. And, when I think about Apple, they're really a product-led and ecosystem-led company. And so I don't think they necessarily need to own the frontier model in order to implement it and deliver good value to their customers. I think you look at the search kind of example, they didn't have to own search in order to kind of deliver that for consumers and benefit from that. So to me, I think it's a different strategy, but I think it fits what they're trying to do specifically. And I think that's why implementing Siri and is going to be a really big focus for the company.
We're looking at Tim Cook in the release right now. He's saying Apple's proud to report our strongest June ever. But I want to look forward with you and just get your reaction to what you're going to be watching under a company that hasn't had a new leader for quite some time. What does John Ternus need to prove to investors like you?
Well, I think, there's probably a lot of continuity with this leadership transition. So I don't expect any massive shift. But I do think John will try to, he'll lead the company in a specific direction. He is a very product-led person, so I think we'll be, hearing about his thoughts on product and then implementation of AI. I think he's got a real focus on making great products. So potentially there's a new product that can come out. And so, yeah, I think there's I don't want to speak for him, so I think that everybody is looking forward to his remarks tonight.
What do you make of the after-hours trading in the stock? It is down 2.4%. Obviously, it's only been a couple minutes, but are you surprised to see that reaction?
It's always hard to gauge what the, initial reaction will be. I think that the earnings call often is what really matters and their outlook. And I think more context on how they're handling kind of the memory shortage situation and now getting gross margin. And I think that, part of what's really impressive about the iPhone is that it is relatively inelastic probably, and then they can probably, absorb costs and with their supply chain and the inelasticity of the product relative to other competitors in the mobile market.
Tony, really appreciate you taking time for us. Tony Wang, Portfolio Manager of Science and Technology Equity Strategy over at T. Rowe. Apple, one of his top holdings in one of his main funds here as we await that conference call out of Apple at the top of the hour. A big focus on Apple's iPhone revenue, which did come in at about $54.25 billion for the quarter. That's ahead of estimates, and a lot of people looking ahead to September when we're hopefully going to get an update here on its latest lineup of iPhones. Nabila Popal joins us right now, Senior Director of Data and Analytics over at IDC. And Nabila, I do want to start off just overall with the smartphone market, because I thought it was kind of alien a little bit. It seemed like the narrative was like people weren't upgrading to the same extent that they had been in the past, and maybe there wasn't enough innovation to get them back. Is that true? And more importantly, what does the release last week of Samsung's new products and potentially the release of Apple's new products in a few weeks, what does that do for the market, if at all?
Absolutely, you're right. So, refresh cycles have been growing across the board. And on top of that, compounding that has been the memory crisis, which has really taken and pulled the whole market down. Where we saw about 7% drop in the global market in Q2. And despite that, which is what's been, a remarkable third consecutive quarter for Apple, has been the fact that Apple grew, and not just grew in a declining market, but grew double digits in terms of course, what we saw in iPhone revenue. But as per our data, 15% year-on-year in shipment growth, which is, again, phenomenal, given, the compounding challenges that we're seeing, both in terms of supply chain, memory crisis, and the fact that, consumers are upgrading later and later. But everyone seems to be buying the latest iPhone, which was a 17.
Well, I am curious about the next iteration and where pricing is going to be and whether that affects shipments. If you believe some of the numbers, I already thought $1,000 phone was kind of expensive, and now we're talking, at least their high-end model, we're going to be over $2,000. And obviously they're dealing with these higher component costs that I'm sure they're not going to want to eat. Is there enough consumer appetite to absorb that?
So that's the interesting thing with Apple, right? It seems that despite whether it was a pandemic or other supply chain disruptions, and then now with the memory crisis, they have come ahead, and it's kind of worked in their favor, right? So looking ahead, the question, of course, the past few quarters have been great, but everyone's asking, can Apple maintain this remarkable growth, right? What's going to happen, especially when they bump up prices for the iPhones, which they've yet to announce, but everyone's expecting it. So we're forecasting up to about $200 increase in the iPhone 18 Pro Max, so the 18 lineup, up to 200. So the Pro Max is going to get the brunt of the increase. But then they can. So the next question is, how is that going to impact their shipments and their performance, right? Because their first, aside from maintaining the growth in shipments, the other priority is, of course, to keep margins healthy, right? And they're industry renowned for the best margins, so they definitely want to protect that. But now, post price increase, is that going to impact? And our assumption is actually no.
Yeah. Well, I am curious, and Marcus McGurman has talked a lot about this, kind of some of the strategies in terms of leasing and other things that maybe makes that $2,000 or whatever it ends up being a little bit less of a bite. But I'm curious about this foldable phone. Yeah. I'm very curious about it because Samsung's obviously been out the gate with this for a while now. I was very skeptical when they first came out with them. I'm starting to warm up to the idea. And as an iOS guy, I don't know if I want to spend $2,500 or whatever Mark said I'm going to have to pay for it. But do you think that with regards to these types of devices, which are new, they get you excited? Because I feel like the last few iPhone refreshes, like for me, who's not much of a tech guy, there was nothing exciting. I don't need another Pixel or whatever the heck they were trying to throw down my throat. But a foldable kind of gets me going. Does that excite the market, maybe, to have something that looks new and fresh?
It's definitely exciting the fact that Apple is finally getting into the foldable space, right? So there's going to be, headline breaking news everywhere, and it's going to create excitement in the foldable market, which remains niche, right? Especially the biggest barrier to that market has been the high price. And now with Apple rumored, or our estimates are it's going to hit about average selling price of $2,500, so even way above the $2,000 mark.
Right.
And is that going to generate demand, right? A consumer is going to go out there and buy that, or the other lineup, which is going to see $200 increase. And our estimates are that yes, just again because Apple caters to a very premium consumer segment that tends to be insulated from the economic crisis. But more importantly than that, what will help drive and continue to drive their growth is the financing and the trade-ins, which are aggressive, right? So if you're buying, most consumers, which is how they purchase it, not just in the U.S. but globally, through with interest-free or financing programs, at the end of the day, it amounts to a short bump, right, $3 or $5 bump on their monthly payment. So that's what helps keep driving the sales.
Yeah, and I keep bringing up Mark Gurman. It'd be remiss in pointing out he's actually sitting right next to us. So I want to bring him back into this conversation here because you've been reporting on this a lot, and I do want to get to this idea of just a design or just having something that the market can get excited about. Regular folks, I know you get excited about everything here, but do you think that this foldable phone, at least based on what we know about it now, that is going to be sort of one of these moments that we used to get back in the day when Steve Jobs would do the wait one more thing and everybody would clap and basically just throw cash at them?
So the stock is now down almost 4% aftermarket. Let's see if my optimism around the foldable iPhone does something here. I have not been this excited for a new tech product in a very long time. I was using the Samsung, their new Fold 8 design about a week ago, and just imagining that thing running iOS, running all my apps, running iMessage, I can't wait. People in the US haven't seen a phone like this before until now. It's going to be super popular, super premium. Some people might not like that the camera is going to be inferior to the new cameras on the 18 Pro and Pro Max. But just that ability to have a phone that's sized as a regular phone that you open up and get an iPad-like screen, optimized for watching video, optimized for gaming, book reading, you name it, side-by-side apps, is going to be very compelling. The iPhone has essentially looked the same for its 20-year history. This is going to be the biggest change in the history of the phone. It doesn't necessarily matter that they're 8 years late to the foldable party after Samsung. They're entering it in about year 2 of these foldables actually getting good. So they fixed the durability concerns. They fixed the concerns about sand getting in and destroying the display. They fixed the concerns with the crease. So we'll see what happens, but I think it's going to be a hot seller, particularly in China as a status symbol.
That's actually what I was going to ask you, Nabila. How do you think this is going to perform in China when there's a ton of products already there that kind of emulate what Samsung has already done?
No, absolutely, and I agree with Mark's said, right? Especially in China, the foldable phone is going to be very important because China is the largest market for foldable devices, with contributing to 60% of the global foldable shipments. And there's a lot of competition there, right? And of course, there's been a lot of criticism that Apple's behind, and when is Apple going to join the party? And now with this phone, we expect them to do, even better than what they have been doing. So it's really going to help them catch up, not just in the tech and the innovation aspect, but also, grab some share from Huawei, who's the #1 foldable player.
Nabila, always a great insight, great research out of Nabila Popal, Senior Director of Data Analytics at IDC. And we also want to thank our very own Mark Gurman, who leads our consumer electronics coverage here. A big focus, of course, on those new products, but there's also going to be a big focus, of course, at the person leading this company into its next chapter. Tim Cook about to say goodbye officially on September 1st. John Ternus set to take the reins. And our next guest, he's worked on more than 850 CEO, board director, and management search assignments. Jim Citrin, chair of the global CEO practice at Spencer Stuart, joins us right now. A real treat to have you here, Jim. First, I just want to get a sense here of how you actually grade this baton handoff between Tim Cook and John Ternus.
Thanks, Romain. It's great to be here. Look, one thing about Apple we all know is that it's a company that is all about excellence. And when it comes to CEO succession, it is the hardest thing and the most important thing that a board does, especially for a company like Apple, where you have Tim Cook, a 15-year iconic CEO leader, following in that footsteps. It's very, very difficult. You can judge any CEO succession by 2 factors. One is the process, and then most importantly, over time, is the outcome. So obviously the outcome we'll see unfold over the coming years, but the process seems to have been perfect, confidential. They considered lots of options, as I understand it, and they came to a conclusion with someone with unanimous board support, with tremendous market credibility and internal credibility. And so we can talk about what goes into great CEO successions, and we study this at Spencer Stuart. As you mentioned, Romain, we do hundreds of CEO successions, and it is the most important work that the board does.
I am curious about the pressure that Ternus is going to be under. I think when Tim Cook took over for Steve Jobs both on an interim basis and eventually on a permanent basis after his passing, the weight of the world was on his shoulders. How do you take one of the most innovative companies led by one of the most innovative leaders and build on it. And there were a lot of doubts about Tim Cook's ability to do that. He obviously proved them wrong on a lot of levels. Ternus, to a certain extent, is going to face that as well, to basically take this company into a new era. I mean, you wrote a book, what was it called? You're in charge, now what? I guess that's my question to you, is what kind of honeymoon period is Ternus actually going to have here to be able to prove that he actually is the guy that maybe lead this company for the next 10, 15 years and beyond?
Well, it's so funny because we study this, and John will have, he'll have a honeymoon period. He'll have the benefit of Tim stepping as executive chairman, and we know that they're going to really craft those roles very, very carefully. But there's something that we've just published on a study. We've studied the more than 3,000 CEO successions since the year 2000 in the S&P. And for those successors who follow what we call a marathoner CEO, those who've been more than 10 years, they actually have a much higher likelihood of success. Even though the shoes are gigantic to fill for John, he will have a trust premium that is built in for the board, the organization, the investors. So the chances are very strong that he'll have a very long run. And yes, there's no easy answer. When it's a turnaround, like take a look at Liputan coming into Intel, that was a gigantic challenge, and it's done a great job in the first couple of years. Here, when you have Tim, who led the growth of the market cap from 350 billion or so to just about 5 trillion before today's slight correction, it's in a completely different situation. So the pressures to grow on that massive, almost incalculable base are truly huge. At the same time, the assets are to work with, and he's got the credibility and the support of the board, the organization, and the investment community.
Jim, that's actually exactly what I wanted to ask you about next. You look at a 10-year return on Apple shares. It's over 1,000% gain here. You just have to wonder if we're going to see a repeat of that for the next 10 years ahead. I mean, the company can only get so large, right? How does that kind of shift the priorities for the next CEO?
Well, and the one thing, most great CEOs, we all know that boards, CEOs, investors look at the returns as the ultimate scorecard of CEO performance. But you have to know that that's more an over time situation. Who would have guessed 15 years ago that there would have been this massive increase? So it's hard to say where things are going from here. But if you can imagine a company with the assets, with the quality, with the culture, with the supply chain excellence, with the brand strength, there's so much to work with. So it's a real leadership moment for John. But it's not just about him. There's the whole leadership team. There's the board. There's the massive organization. There's the customer base, all the experts. So a lot of people, of course, are rooting for him and rooting for the company to continue to thrive.
They certainly are. I am curious, and this is a question about Ternus, but really a question about all the searches and other consultations you've been involved in over your storied career. And it's that question that always comes up about whether you go for an insider or you go for an outsider for the company. Obviously, they chose an insider. At least right now, it looks like the market's pretty comfortable with that. But we've seen some other successions in recent years where we've seen boards flub that in a big time. And I'm curious, is there sort of a formula or at least a question that you ask yourself and that matter of the board to try to determine whether an insider or an outsider would be best for the next leg of the company's history?
I'm so glad you asked that question, Romain, because that is really the question that boards often ask. And we've been studying that question for 20 years. The general direction on that question is that when a company is performing well and there's a clear strategic direction and there's conviction on the business, insiders tend to be lower risk and slightly outperform. When a company is in a crisis or a turnaround, Boeing, Intel, there are others, then that does conditions favor an outsider who can come in and change the culture, build on the strengths, and create a new direction. But actually, overall, as most boards really believe that it is a benefit to have an insider, and generally that often works the case, but the actual data show that the performance is pretty much identical, but the risk or the beta is higher for an outsider. So the upside is a little greater, the downside is a little greater as well. The big point is that boards do it well when they consider all the context. They consider insiders, they at least benchmark the external talent, and then try and make a judgment based on the forward-looking needs of the business, and then try and back in what are the right leaders for that. So in this case, they clearly have done that, focusing on where the company's going, and that John would be the right man for the job.
Jim, really appreciate you taking time for us. Real pleasure to talk to you. Jim Citrin there, chair of the Global CEO practice over at Spencer Stuart. Decades of experience in helping boards find folks to actually transition their companies to the next chapter. Meanwhile, we are looking ahead to the next chapter, and that's two big conference calls coming up at the top of the hour. Amazon, those shares up 8% here in the after hours trade, and Apple, those shares down 4% in the after hours trade. Bloomberg Tech's Ed Ludlow joins us right now to talk a little bit about that. And Ed, let's first start off, if you will, with Apple. Obviously, we are going to hear from Tim Cook, presumably his swan song here, but people really want to know a lot more about pricing, a lot more about their cost inputs, and a lot more about when we're going to get these announcements on these new products.
Exactly, a clean beat, but just how clean, right? And what kind of a world does Ternus take on in the September quarter? You know, strip out the tariff impact to gross margin, 48.1% is exactly what the street had modeled for. It's likely that there's still some iPhone upside to come. There's a lot of evidence that demand is there for iPhone, a category that they had a clear beat in, and the memory pricing impact hasn't really manifested yet. What we hear from a lot of CEOs is that actually we've got to stop focusing just on the pricing of memory and the real-term supply, because the demand is there. How hampered was Apple in its ability to get the handsets out? That's another question. So yeah, it's a passing of the baton, but quarter to quarter, I think a lot of people are saying quickly, the world will look very different in 3 months' time to how it looks this evening.
Just give us a quick preview of Amazon, the company reporting a 5th straight quarter of cloud sales growth. What's the AI story coming up next?
Yeah, the AI story is that AWS is smashing it, and that's good. What happens when they say something about the forward nature of capital expenditures? You know, they have all these metrics to show that AWS is more than just cloud computing. There's an AI story, but the spending trajectory is everything.
Can I just stop you there? So we didn't get that Capex number in the release. I assume we're going to get that on the conference call. But everyone's focused on that free cash flow number, or lack thereof. Is that sort of an indication of maybe what they might say, or should I not read too much into that?
Hey, you know what they say about assuming. I thought that Meta would give us a 2027 Capex figure last night. They did not. And then look what happened. So it's so interesting. I just don't know.
All right, Ed. Well, it's been an interesting couple days. We talk about just the phenomenal day that Microsoft had on the back of its earnings report. It looks like Amazon for right now is getting rewarded, Apple getting dinged. Ed, we'll say goodbye to you. Ed's going to probably stick around for BOP to help break down some of the things on the conference call. And you can check them out, of course, at 11 a.m. tomorrow Eastern time on BTech. Well, I'm sure they're going to have a full analysis of everything that's going on. But for us right now, in the moment here, I think we're kind of seeing this narrative play out here, right? The idea that their companies are going to get rewarded if they can show that ROI, and the ones that can't, or at least the ones that are in doubt, aren't going to get it.
I really do want to see these Capex numbers remain. As a credit reporter, that is so important to just how the company's balance sheet looks, and of course what happens next with
it was interesting.
How they're going to raise.
We started the show with Bruce Richards, a big credit investor. He said he's not too concerned about the AI credit space right now, at least on the investment grade side. But we'll see here. Microsoft delivered. It looks like Amazon did too. Both of those conference calls for Amazon and Apple coming at the top of the hour. If you're interested in politics, stick around for Kaylee and Joe with Balance of Power on Bloomberg.